This is a show where all three of our guests could be the headliner. So we hope you're not going to get desensitized to great financial talk the way Eric Stein, Chief Investment Officer at Voya Investment Management, worries that the market is doing with all of the headlines.
One of my core beliefs as an investor is that markets get desensitized to the same news or similar news over time. And so whatever it is, whether it was where LIBOR fixed back in the '08 financial crisis or the price of oil in 2014 as oil was falling, or regional bank stocks in 2023 as there were the issues there, the broad financial markets, while they can fixate on something for a particular point in time, they get desensitized over time to the relative same thing.
He's our big interview and batting cleanup in a show that starts with Matt Freund, Co-Chief Investment Officer at Calamos Investments, here for The Navigator, talking about interest rates, the market, and what he thinks will be happening with closed-end funds as the Fed moves into a rate-cutting cycle that he says will be 4 cuts in the next 12 months. Then Jeff Bishop, Chief Executive Officer at RagingBull.com, gives his technical take on what's happening with the market, but points out that this is not a trend you want to fight because the money to be made is still to the upside. All that, and I'll give a quick answer to a listener's question about whether private equity and private credit belongs in 401k plans.
Unleash the beast.
Oh yeah, as shows go, this one is a beast. Welcome to Money Life for August the 15th. I'm your host, Chuck Jaffe, and we have an incredible show for you today. I mean, the interviews are just right on. And like I said, all of them could have been a headliner. We've got great quotes from everyone. And if you don't watch our promos, well, I keep saying you can find us on LinkedIn or look at our Facebook page or what have you. This show is available to you on YouTube. We post it there as an audio podcast, but all of our clips also go to YouTube as well. YouTube's really tricky to build an audience with. We would love it if you would get more involved in the YouTube thing as well. So go find us. Go to YouTube and search Money Life with Chuck Jaffe, and you'll find our clips there. So again, Instagram and LinkedIn and X and whatever, we're on all of those, and Blue Sky as well. But don't forget you can find us there. I'll probably remind you again in the coming days. One of the things that I say all the time, and maybe you'll experience it here in terms of what we've had going on the show last week and this week, is that, it's really easy to do a great show on a day when you've got a huge powerhouse name, somebody like Urian Timmer, who was on the show last week, or Paul Grunwald, the chief economist at S&P Global, et cetera. You get those names, everybody wants to listen to them, and banger of a show. Now, Voya, big investment company, Eric Stein, their chief investment officer, he's a pretty big name, but he's relatively new to being a headliner compared to, say, a Urian Timmer. So he's not somebody who is necessarily as well known. I think eventually he will be incredibly well known because he's very well spoken. But you got him, or you've got Matt Freund, both of whom big picture thinkers, and you add Jeff Bishop in there. Yeah, it's a powerhouse lineup. There will be a little bit of talk about producer prices. They were higher than expected. What that's going to mean, when we're going to see rate cuts and more. There is some interesting agreement in a way that disagrees with an interview we had on the show earlier this week. I'll tell you about that at the end and more. So buckle up. We got a great show to get to. The Navigator with Matt Freund from Calamos kicks us off right after this message.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Matt Freund, Co-Chief Investment Officer at Calamos Investments, is here. We're talking about interest rates, markets, and how closed-end funds are performing through it all. This is The Navigator. Welcome to The Navigator, where we talk about all-weather active investing, plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, a unique industry organization representing the full spectrum of the closed-end fund business, from users and investors to fund sponsors and creators. If you're looking for excellence beyond indexing, the Navigator will point you in the right direction. And today we're looking at the market and the economy with somebody who actually goes from that investor side to also the fund sponsor and creator side. Because Matt Freund is co-chief investment officer at Calamos Investments, which has a wide range of funds, including, of course, closed-end funds. But before this conversation is done, we're going to be talking about the Calamos Closed-End Fund Income and Arbitrage ETF. That's CCEF, which makes them an investor in closed-end funds. If you want to learn more about the firm and what they do and about their fund offerings, go to calamos.com. And if you want to learn more generally about closed-end funds, interval funds, and business development companies, check out aicalliance.org. That's the website for the Active Investment Company Alliance. Matt Freund, welcome back to The Navigator.
Oh, it's my pleasure being here.
Let's start in general with interest rates because, well, so much of closed-end fund activity revolves around bonds, fixed income, treasuries, and the rest, and munis, et cetera. So we've been waiting for a rate cut. But even when we got rate cuts last year, the market didn't really perform the way we expected. So when and where do you think the rate cuts are happening? But when they happen, are we going to see the impact, or has the impact already been priced in?
Well, a lot of the impact has been priced in. So I think the answer to your question, we'll hit it concisely at the start, is that we're going to be seeing a couple of cuts this year, followed by 2 or 3 cuts next year. So I would expect when we're talking again next summer, that rates are going to be 100 to 150 basis points lower. Within that range, my guess is that it'll be closer to 100. But again, a lot's going to depend on data that comes out between now and then. But the question you asked, I think, is really important. What's the reaction going to be? So last August, I was wrong. I thought the Fed was going to cut 25 and they cut 50, and the market didn't like it. And with the market, I mean the bond market, because the long end of the curve, call it 10s, 20s, and 30s, even though the Fed cut rates, the long end of the curve had rates going up. So the curve got steeper. And that was, I think, a vote of the Treasury market saying you're going a little bit too aggressively. I think this time they're very aware of it. Once they start, I don't expect a 50. I know that's been in the press over the last day or two, but I think they really want to reassure the long end of the curve. They don't want to do anything to disrupt the Treasury buyer.
You don't expect the 50, just out of curiosity. Do you think that they're cutting at the next meeting, or are they going to wait absolutely as long as they can, get one more month of that data in to say, okay, now we really are seeing the inflation that we think we're seeing, and now let's make it?
Yeah, so I would bet that they would cut in September. I think the wild cards for that, we had a CPI reading today that was on the high side. I'm sorry, PPI, but the CPI reading we had 2 days ago was fairly well contained. And it's our forecast that inflation is going to stay at current levels or trend up a little bit over the next couple of readings. So the inflation backdrop isn't going to help, but we're getting a lot of certainty. We're getting certainty certainly on the fiscal side. The big, beautiful bill is now law. We're getting more certainty around tariffs and what that's going to look like. And we're seeing the impact of that. Putting it all together, I think there's a pretty strong case to start cutting, but to do it in a very measured and deliberate way.
150 basis points in a foreseeable period of time, that's something that managers, traditional managers, closed-end fund managers, et cetera, will react to. How do you see the market responding? And from a closed-end fund perspective, do you start to do bargain hunting because rates going down, discounts tend to expand, or what have you?
Let's do the bond market first. Credit spreads are very, very tight, in some cases at all times tight. So can that continue? And the answer is it can, but I think that we're really at the low end of the range. I wouldn't expect to see credit spreads come in a lot. In terms of the Treasury curve overall, if they are very deliberate, if they're doing it from a position of strength, meaning inflation is low enough and they have enough certain policy uncertainty has gone away that they can cut rates, I think that would be perceived pretty well by the long end. Now, on the other side, if they're seen as capitulating to the administration, if they're seen as doing things for non-monetary reasons, that could cause trouble, but I don't think that's going to be in the cards. So my base case is that the Fed will cut in a very methodical way, that the long end of the curve, again, could it go to 475? Sure. I think that's kind of a long-term fair value, but we're going to have a nice gentle curve where you have rates around 3 by next summer, and you're going to have the long end 4.25, 4.5. And that is a very supportive environment for credit spreads and risk assets. And then on the equity side, I do a little bit of work there too, helping out some of the teams. The large cap growth names, they have fortress balance sheets. They're really not trading based on interest rate expectations, but the cyclicals are. Some of the small cap names that have a lot of floating rate debt are. And I think that you're going to see those get some positive impacts if the Fed were to cut rates. And certainly we can see it in housing is, I think, a case in point that if they can reduce the front end without the long end getting out of control, there's a lot of pent up demand in the housing space that's going to be unleashed.
Is that changing where you're looking on the equity side?
Well, we do expect there to be a broadening in the equity market. It's difficult right now because there really are just a handful of stocks. It's not just the Mag 7, but it's not a huge list beyond that are driving all of the performance, which makes sense when you realize that they're driving all of the cash flow and earnings growth as well. But we do expect that to broaden out. And actually, I've been surprised that it hasn't broadened out more already. But we are seeing that healthcare seems to be hammering out a bottom and starting to regain its footing. I'm not a technician, but the research that we get shows that places like industrials and financials and small caps also are gaining some relative strength there. So I do think a broadening is in the cards, but the key is going to be that those interest rate cuts are very deliberate. They're done from a position of strength, and they don't do enough to spook the long end of the curve. And certainly we've got the tariff uncertainty too. Again, there's an assumption there that that's going to continue on the path, not for the first 2 weeks of April, but what we've seen since then.
The broadening that you mentioned, will that extend all the way to small caps, or is it not going to get quite that far?
No, I think there's a lot of reasons to think that it would. I think that if you look at broad asset classes, small caps relative to large, earlier in the year, they were as cheap as they ever been. We have a very talented small cap team. It's our Calnos Timpani team up in Milwaukee, and they do a great job. And again, the opportunity set that they're seeing, they're very excited about. And that makes sense because when all of the focus is on that Mag 7 plus, call it another half dozen or so, that's where all the action is. They're going to be overlooked opportunities, especially when those areas are exhausted. And we don't think they're there yet, but we're worried about it and watching, meaning the Mag 7.
Let's bring this over to the closed-end fund space, where the Calamos Closed-End Fund Income and Arbitrage Fund is a fairly new fund. It opened in 2024, so you don't quite have 2 full calendar years at this point. Year to date, it's up about 9% at a time when the stock market is up about 10%, but it's doing it with a very different kind of portfolio. So what are the opportunities you see in closed-end funds at this point, and how much of it is just simple discount narrowing?
A couple of things. So the fund has been around for about 2 years, as you said. We were running it as a SMA before that for a little over a year, and we were running it in simulated form for about 18 months before that. So we have a live track record going back further. And really the history here is Calamos has a long tradition in the closed-end fund space. It gave us great insights. And again, we're not only operating closed-end funds, but looking at it from the investor lens. So we think that gives us a leg up. Our philosophy there is twofold. First, our investors want income. So it is designed to have a heavy distribution yield. But really, we're looking at two things. The first thing we're looking at are opportunities where the baby's been thrown out with the bathwater, where the discounts we think are unjustifiably wide. And so part of the investment thesis there is that sectors are out of favor relative to themselves and relative to the other opportunities in the marketplace. The other thing we look at is income, but this is really important because it's not just income, it's return of capital adjusted income. So what does that mean? So in the closed-end space, fund companies can distribute more than they earn. And it can be constructive, meaning I have a lot of NVIDIA, I don't want to sell it. I will have a distribution that is covered by unrealized capital gains. So your net asset value is gradually increasing. You're returning some capital in lieu of realizing a gain. That's fine, but other companies can have destructive returns of capital where they're giving you your own money back in the form of yield. So we adjust for that, and it takes some work. We do it each time, every time, and make sure that the ROC adjusted yield that we receive is attractive. So when we look at the marketplace, we have gotten a nice return from having those discounts close, but we've also gotten a nice return on a ROC adjusted basis, meaning from earnings and realized gains, not from returns to capital. So we do those two adjustments and find that it wins for us over time.
You know, we've got a market that's at record highs. Are you liking the general discount picture out there? I mean, is it a lot to choose from as you're building it?
So discounts have come in for sure. And the pattern that we see, it's the same pattern of fear and greed that when investors run for the exits, they're less discriminating about the price that they pay. They want to get out and get out now, and it'll create discount opportunities. So April, things were a lot wider than they are today when the markets are up and investors are relatively happy. They're not selling, and the natural result is that discounts close. That being said, right now, our discount is on average between 7 and 8%. So that's, again, it's tighter than it was, but we still think that's attractive when you look out at what's available in the market. And our yield, so again, getting to the ROC adjustments, after adjusting for our return of capital, our ROC adjusted yield is almost 7.5. So we like the yield backdrop and what we're doing. We like where the discounts are, though, to your point, they've been wider. And then the last thing that I would throw in there is we were talking about rate cuts. I do think there could be a growing opportunity in the muni bond and the fixed income space broadly. So you have to look at the forms of leverage that closed-end funds will implement. And again, we spend a lot of time doing that. If you're borrowing on the short end of the curve and investing in the long end of the curve, given the inversion that's going on, that's not a great setup. I do think that a steepening curve where the front end comes down, the cost of borrowing for closed-end funds comes down, could present a nice springboard in certain of those funds. So we're looking there. We still like the MLP space that hasn't done as well for us recently. It's still positive. It hasn't kept up with the broader market, but we think there's opportunities there. We think especially with some of the AI build outs that's going on, that natural gas is definitely going to be a part of it and that those funds will benefit as a result.
Matt, really interesting stuff. I appreciate your time joining us on The Navigator. We'll talk to you again down the line.
Looking forward to it.
Matt Freund is Co-Chief Investment Officer at Calamos Investments, and you can learn about the firm and its funds, including CCEF, the Calamos Closed-End Fund Income and Arbitrage ETF, at calamos.com. Later on today's show, Eric Stein, Chief Investment Officer at Voya, will be joining me for the big interview. But up next, we're talking technicals with Jeff Bishop from RagingBull.com. Woo-hoo! Stick around. This is Money Life.
Logic dictates that given their extremely high level of technical development.
Well, it's too technical to explain to the lay mind.
Oh, I would not say that technical analysis is too technical to explain to people. It's just something that's going to help you understand what's happening with the market's charts. And one of the people who explains it best, who I'm always happy to speak with when it comes to what's happening on the market, is Jeff Bishop. He's Chief Executive Officer at RagingBull.com. And if you're not familiar with Raging Bull, well, you should know that during the Money Life era, there was a point where they were doing a little bit more with their editorial, and I was running their editorial efforts. So I've worked with Jeff. I do not work with Raging Bull now, but obviously we parted on great terms because I'm always happy to chat with them today. But Jeff's not just the chief executive at Raging Bull, which you can find out about at RagingBull.com. He has an options trading service. He publishes his best trade ideas in his weekly options service, Bullseye Trades. You can learn about that at bullseyeoptiontrading.com. Jeff Bishop, it's great to have you back on Money Life.
Man, that's a great introduction. Thank you, Chuck. It's always good to be here.
Let's start with where we are right now, because we've got a market that has worked its way back to record highs. We had our first close on the S&P 500 of over 6,400.
Right.
We've done this and climbed this wall of worry. It certainly seems like intuitively we should have more downside risk than upside potential at this point. But how much is that actually true? I mean, is that what the numbers are telling you?
This market has got a lot of people scratching its heads. And all I know is that as a trader, you got to shake out all the nonsense. You can't really listen to explanations. All you can trust in is the market. And when the market keeps making new all-time highs and people are complaining about wars and unemployment and inflation and all the stuff, the market, every dip gets bought. We keep making new highs after all this bad news. You just got to stick with it. I don't see breadth in the market starting to slip at all. We talk about technical analysis. Looking at the market on moving averages looks super healthy right now. I don't really see any reason to not want to continue to buy the market here. So I hate to do it. It's kind of like a hold your nose and just buy it situation, but I continue to go long trades right now and it just continue to keep working. So I'll stick with it.
You talked about trades, and I don't know your current positions, but one of the things that you like trading the most is gold. It's always been part of what you do. Gold, of course, has had a banner year, but I can tell you that on this show, we have had some divergent opinions. Like, yeah, it's got way more to go. And the miners, who I know you also like trading in the miners, and the miners have had some big predictions. And then I've had the end is near for gold. So how about on the gold market? Where are you there right now?
Right. Another tricky one. I mean, it doesn't create any dividend cash flow, so you can't really value it. We're just trading it as a fear or trading on insurance against the future. I still think it's a great trade here. So I keep seeing the dips get bought up there too. That just shows the market is really, really strong right there. So people are, forecasting a lot of catastrophe around the corner, or a Fed default, or interest rate blowups, and gold's a great hedge for that. We just continue to see it get bid up more and more. Same with crypto. So, crypto is kind of going hand in hand there. We're seeing people flood to non-fiat currencies. I want to say that, but anything that people can get into and they feel safe from the government, they're really piling into all over the world. So, gold's getting a bid there too.
From that standpoint, I mean, when you and I were working together, crypto wasn't really a thing that anybody was talking about.
Yeah, no one cared. I wish I did. Wish I bought all the crypto I could then.
But that being the case, I mean, for you, because you're an options trader and because you're looking at those sorts of things, is crypto just another asset? Like, is it just understand the asset, trade the asset, or understand, more importantly, maybe the trading patterns that you're looking for rather than the asset, and crypto behaves like everything else? Or is crypto truly different than almost everything else?
I mean, it is truly different. And I don't think there's many people in the world that truly understand the intricacies of every coin or every crypto meme, whatever it is out there. So if you really understand each one of these, you might have solid reasons why you want to buy a Bitcoin, for example, or Solana or Ethereum. There might be reasons why, but as a trader, I just look at them as trading vehicles. So they ebb and flow with how are the markets feeling about interest rates and their risk on mentality. So there's a lot of things that drive those. And I really like just trading them. I don't trade crypto directly. I trade a lot of the crypto treasury stocks nowadays. They just have a lot more liquidity and they seem to have leverage on crypto itself. So for me, that's how I prefer to trade them.
And you prefer to trade the crypto treasury stocks as opposed to trading the crypto ETFs?
Yeah, I do actually. I do trade the ETF sometimes too, but the treasury stocks seem to have a lot more upside and downside leverage to the coins there. So I prefer to trade those.
Let's go back to the broad market. What you said is, I'm going to keep riding this pony till it shows me that it doesn't have any legs left. But what's going to be the signal for you? It's not that you can necessarily pick the market top, but at what point do you go, okay, I'm not theoretically worried anymore, I'm actually worried?
The markets typically make tops when they have several steep drops. They get bought up, they keep retesting highs, and just don't make new highs after that. So they don't typically just have, we had a V-shaped recovery off the bottom, which was pretty amazing back in April, but we don't typically see the opposite as a sharp rally down. We see like a rolling top where the market just can't make new highs for a while. It starts slipping below. Number one, I look at like the 20-day moving average, which is a favorite indicator of mine. We start seeing stocks in general start trading underneath the 20-day moving average. All the leaders start seeing chip stocks start to fall apart. AI stocks really start trading under their moving averages. Some stocks have a lot of bad earnings that have been leaders. Those will be good signs that it's probably time to start taking chips off the table. Maybe not time to go short, but those are good signals when to just kind of take chips off at least.
And do you have a sense of when we get to that top, where you would think the market would reset to? Like, are you expecting, yes, there's a correction, which is, pretty easy and tradable, but not that deep, or something worse? Like, in your opinion, are we reinflating a bubble like we saw in the internet days? It
really depends if it's like news driven. So, Trump could always come out and have a new tirade of something that drives the market irrationally lower, like happened with the tariffs. It could be some other thing that happens. So it could be a news driven thing, which might push the market lower than it should go. But I would expect to see about a 10% pullback at some point, probably in the next few months, actually. I still think that we always have that Christmas rally heading into December, but I would expect that there's a pullback here pretty soon. We're pretty due for it.
And so pullback, then rally towards the end of the year. I know you are short-term driven, but you always have an intermediate or longer-term outlook in the back of your mind. So is 2026, as you start to look out that far, shaping up to be okay?
It's hard to ever not be bullish. I mean, how many guys have made money not being bullish on the market? So I always want to think we're going to go higher. We'll see where we end up this year. I think the markets will have a close to a 10% correction from here, but I still think we'll end the year higher. So I think that will happen. And the following year will be choppy as well. I don't expect huge gains, but I do think that we will continue to trend higher in the 10 to 15% range of the market.
Well, I don't think too many people are going to argue with that one, Jeff, in terms of, I think most of my audience would be pretty happy if that's how it turns out. We, of course, will see how it turns out, and we'll check in with you again down the line. But meanwhile, thanks so much for joining me today on the show.
You got it. Thank you, Chuck. Good to talk to you.
That's Jeff Bishop. He's the Chief Executive Officer at RagingBull.com. Check out the website there. Learn about his options trading service. It's known as the Bullseye Option Trading Service. Bullseye trades at bullseyeoptiontrading.com. And we have one more big interview to go. It's the big interview. Up next, Eric Stein, Chief Investment Officer at Voya Investment Management. He joins me as Money Life rolls on.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Welcome back to Money Life, where I wanted to take a little bit of time to go off the news. Actually, I could have done this as the question segment as well, because it's based on a question, but it is off the news. So we'll jump right in. We got a note from Mike in Syracuse, New York, and he made a comment about Syracuse being the lacrosse capital of the world. I'm not arguing. There's some other places that might lay claim to it, Mike, but that's not your question. Your question has to do with private investments in 401k accounts. And specifically, Mike asked, Chuck, what's your take on adding private investments to retirement accounts? Is it a good idea? Curious for your opinion. Mike, you've never written me before, so I don't know anything about your circumstances, but I am happy to offer my opinion on this. And for anybody else who wants my opinion or has questions, etc.
I'm sorry, but all questions must be submitted in writing.
Just send them in, chuck@moneylifeshow.com. So first, the news, in case you missed it. Last week, and I did mention it on the show, President Trump opened the door for alternative investments to be offered in retirement plans, defined contribution plans like 401ks. The order instructed the Department of Labor and other federal agencies to review the regulatory rules that fiduciaries of those plans must follow, and listed in order, it allows the following assets: private market investments, which would include private equity, private debt, private credit, and other non-public instruments; real estate, including debt that is secured by real estate interests; digital assets, so crypto, etc., commodities, infrastructure financing projects, and lifetime income strategies, including longevity risk-sharing pools, etc. Now, most of these investments are available to investors through IRAs. They're also in Roth IRAs. They're in taxable brokerage accounts. A self-directed IRA may be necessary for some of them, but I'll point out that private market investments typically require investors to be accredited, which means they have a certain level of income or wealth. There has been some demand from workers to invest in cryptocurrencies in their 401ks and their 403bs, etc., but there hasn't been a lot of demand for private investments, even though you could probably suggest that, given what we hear on the Navigator segment, where we've talked with plenty of people, that private credit might have a reason to wind up doing it. No, it doesn't really seem like it's the public that's saying, I want private investments in my retirement plan. It seems to be the industry saying, we want to offer private investments so that we can generate money there and move more money. Now, if you wanted to make an argument for why you're going to have private equity, it would be diversification and returns. Whether it's private equity or private debt or direct lending or venture capital, they have proven that they diversify portfolios, and especially portfolios that hold publicly traded securities, because they're infrequently bought and sold. So as a result, their values are based on prices from transactions of similar entities. They're more estimated than they are confirmed, but that doesn't mean you know the real market value. That means you've got an estimate. It kind of stays there and you just watch it build up as your account goes. But at some point, the market will come up with a real value. You could have real problems. I mean, think about it like if you were looking at a website for the value of a car, we can kind of tell you what the car was worth the last time one like it traded, but then your car's unique features and maybe its unique shortcomings will determine the actual price. So the plus side would be diversification. The downside would be cost and liquidity. All of those investment categories that I read to you just a minute ago come with higher investment fees, higher costs, diminish returns. It's that simple. And oh, by the way, the Department of Labor has tried very hard, and a lot of cases have been fought to make it that the people offering plans have to try to pick low-cost investments. Well, you can pick the lowest cost private investment, and it's going to have higher costs. But beyond just the costs, lots of private investments have restrictions on timing and frequency of trading, limits on how much can be withdrawn. I mean, that's what interval funds are about, right? You could have mismatches where retirement plans, which have constant inflows but erratic withdrawals, wind up doing something that can make it that either people can't get their money back or what have you, or maybe the other way, they wind up flooding something in. So what safeguards are going to be put into place if somebody is not able to access the money that they need because they're in something that's illiquid, but now they need a hardship loan or they're moving and what have you? You also have to worry about suitability. We know in retirement plans, folks are historically super safe. That's not a bad thing. Well, these are distinctly not safe. But if you barely understand how to use a target date fund, you are not going to understand what to do in private equity. So that's my take on it. I wish I had better news. I'm not suggesting that, like, Mike, if you were asking, should you do it? Like, if it's going to be offered, would you take it up? That is a question that is completely unique and individual. Private equity in that realm is no different than, say, small caps or whatever else you might do because it's an asset class. And you can decide if you want to have it represented in your portfolio. And if you do, you can take care of it that way. But I would not suggest that this is a great idea. It's not a terrible idea. It's just going to create some issues. Hopefully, most people won't get caught up. Thanks for the question. Remember, if you got a question, chuck at moneylifeshow.com. Big interviews coming up. See you around there. It's time for the big interview on the August 15th edition of Money Life. Returning to the show now, Eric Stein. He's Chief Investment Officer at Voya Investment Management. You want to learn more, you just need to know the name of the firm. It is Voya.com. Eric Stein, great to have you back on Money Life.
Yeah, super excited to be back with you, Chuck.
We are now at a spot where, hey, we've gotten through to where we have tariff clarity. We have started to see some things show up in the numbers. And everybody's been nervous, but the market has climbed the proverbial wall of worry. Does it keep climbing at this point, or do we need to be prepared that something is building here?
A fantastic question. I think what's been driving the stock market higher is that treasury yields have fallen. So we've had lots of inflation data. We had CPI and PPI both out this week, and we've just generally seen a rally in treasury yields. As I'd say, broadly, investors are less concerned about the inflationary impact of tariffs, though there's still concern definitely still remains. So as treasury yields have fallen, the stock market has gone up. And I think if treasury yields stay low and the Fed can deliver a cut in September, the markets can do well. But there's still a lot we don't know about the inflation setting process vis-a-vis tariffs, things of that nature, other things that had been driving yields higher. So I think markets likely continue to do pretty well, but there's certainly risks out there.
When last you were on the show, it was the beginning of March, and you used a phrase that almost no one else used. You were talking about the sequencing of policies and how it was impacting the market. Well, now we've gotten through the sequence of here's the tariffs. And the next sequence that people are expecting is deregulation. Deregulation, take away a lot of things from people, and you're going to wind up in a situation where they've got more money to spend that they aren't spending on compliance. Is deregulation an investment play? And is that what's next to maybe fight off some of the negative effects of tariff inflation?
Yeah, no, I think that's a great point. And to me, we've gone from a world hyper obsessed about tariffs in April to more of a focus on fiscal policy. And then we got the big, beautiful bill out there. So less of a focus on fiscal policy. And now it's really, as you said, around regulatory policy as well as other things. But getting a deregulatory impulse in the financial sector, getting a deregulatory impulse from a M&A activity perspective, helping animal spirits in the economy, AI, the crypto sector, all those things are positive for the stock market. So I definitely think, look, financial markets are forward-looking mechanisms. They discount the future into today's price. And so that's why I think markets look through after the initial shock tariffs so quickly, and now they're focused on other things.
At the same time, while markets looked through them, most investors haven't been able. Like, we are conditioned, because I'm sure you learned in business school, the same way that I learned in economics class, what's supposed to happen. And it's funny because it's not just that we haven't seen some of the price increases we expected with tariffs. Go back to last year where we didn't see the impact that we expected from rate cuts. And now we're talking about rate cuts again, but we're in this environment where we haven't seen things. Are things changing for some reason why we don't see the impacts that we expect?
It's a great question. I think I'll take it in two parts. From a rate cut perspective, there's always, there was a question when rates were going up, why the economy didn't break quicker with the Fed, raising rates in 22 and 23. I think that was just, less interest rate sensitivity on certain parts of the curve and certain parts of the macroeconomy. And then on the price impact from tariffs, A, the tariffs have been delayed and changed multiple times. B, there's always the question of how much the companies take on versus how much the consumers take on. And then C, it's also goods, services, different things that are tariffed versus aren't tariffed and are moving around so much based on a lot of other factors in addition to tariffs. So I certainly think all else equal, do tariffs make prices go up? Absolutely. How much? We don't perfectly know.
What we've also seen is that every reaction to every announcement has been less severe. We had the first announcement, big market moves. The second announcement, smaller, but still pretty big market moves. And now the market kind of goes, ho hum, another announcement. Does that mean everything's priced in, or does that mean this is a market that is primed to be surprised and maybe badly surprised?
So I think that's a great point that you make in that question. And one of my core beliefs as an investor is that markets get desensitized to the same news or similar news over time. And so whatever it is, whether it was where LIBOR fixed back in the '08 financial crisis or the price of oil in 2014 as oil was falling, or regional bank stocks in 2023 as there were the issues there, the broad financial markets, while they can fixate on something for a particular point in time, they get desensitized over time to the relative same thing. So it doesn't mean if the tariffs were massively worse than and stronger than expected that markets couldn't sell off, but there is some amount priced in of just general tariff noise. And I think that's really consistent with that point I was trying to make of markets getting desensitized to the same thing going forward.
Given that markets get desensitized, are we in that position where a surprise is more likely, like where we've priced things in, but we've priced them in on an area where we're kind of numb?
Yeah. So look, we've had a couple a couple of weeks ago or a month ago, I thought the market had almost forgotten about tariffs. And then there was, noise out on tariffs with China, or noise out on tariffs with Europe, or tariffs with different other countries. And the market would move a little bit and then come back. So I don't want to say the market's completely immune. I just think it's largely immune and focused on other things. Again, we go back to the spring, April tariffs. Then we go into, fiscal policy was a lot in May. Then we go into geopolitics in June. And here we are in August. We've gotten through some of the fiscal stuff. Geopolitics seem to be getting incrementally better, potentially better with Russia, Ukraine. And so there are just, to me, markets focus on different things at different times. And sometimes it's really tough to predict what's going to trigger a market reaction one way or the other.
What the market was focused on after the tariffs were announced was the likelihood of recession. And we saw virtually every pundit come on and say, odds of recession are much greater. What nobody is focused on right now is recession. In fact, I've had one or two guests suggest the opposite. They're like, we're more in jeopardy of recession because no one's expecting one, which I'm not sure I agree with, but nobody's talking about what kind of landing we're going to have. And we entered this year still at least thinking there might be a landing. So recession, landing, what's going on?
You make a great point. In April, all everyone could talk about was recession. And look, I think as the market impact of tariffs dissipated, that meant that the financial conditions tightening that we saw right around Liberation Day eased up. And so, less financial stress and also just less broad, macroeconomic stress from that perspective. In terms of the economy today, yes, while less people are talking about recession, we are seeing some weakness in the labor market, incremental weakness. The labor market is still strong by historical standards, but it's getting incrementally weaker. Layoffs aren't high, but companies hiring a lot of people also is pretty low. So it's not a booming labor market like we had a couple of years ago. It's not a terrible labor market at all. And so if things continue to weaken somewhat in the labor market, then to me, it really comes down to the Fed, which is highly correlated to inflation. If inflation keeps coming down and the Fed can cut rates, then likely the economy still keeps going quite strong. If we saw an inflation shock that forced the Fed to not cut rates, other things went on that drove treasury yields of the back end up, that could be real problematic. But if we can kind of muddle through with a good but not great economy and have a lower rate structure, that is quite positive both for markets and for the broader economy.
I guess the follow-up obviously would be, think the Fed can do that? Can the Fed pull this off and make it that we don't see a spike in inflation?
I think they can. Look, I think generally the inflation data has been more benign relative to this expectations of what was going to happen with tariffs. Again, we still haven't gotten through all of it. We still don't know exactly how that works. Obviously, if the Fed's just looking at growth with the labor market weakening and looking at where inflation has come from to today, you would be cutting. If the Fed's looking at the actual inflation level where it's still above target and also the uncertainty around tariffs, and that's really where the big debate is, then you wouldn't be cutting. And obviously there's a political element going on right now with the Fed as well. So I do think, look, the Fed, people were talking up, including Treasury Secretary Bessent, 50 basis point cut in the September meeting. That was before the PPI print. I think now it's most likely that we'll get a 25 basis point cut at the September meeting, and then we'll see where we go from there.
So you are expecting the rate cut to come, and at the next opportunity, are you expecting, and especially because I haven't mentioned it, but you came to this job on the up from the fixed income side, will we see a rate cut have the broad impact we normally expect rate cuts to have, or is this not going to really have that impact because it's either been priced in or the market doesn't care?
Yeah, so look, the Fed, to me, people, it's misguided to look at, well, the Fed cut 25 basis points on whatever day in September that the Fed meeting is, and then, hey, the 10-year Treasury didn't move. Well, the 10-year Treasury moved in anticipation of the Fed cut. So part of the reason we've seen a rally in Treasury yields, particularly at the front end, is pricing in these Fed cuts. So I am a strong believer the Fed monetary policy operates through the financial conditions channel, through financial markets. And as financial market prices change, and think interest rates on bonds and how that relates to the price of mortgages for the average consumer, that's what flows through the real economy. So I do think Fed policy will have an impact. It already is having an impact. It just may not happen on that exact day. Likely won't happen on that day.
Moving this back to the stock market, when you look at where things have been this entire year, while this market has been up, Europe and international has been much stronger. There is a school of thought that this is the start of a long rally. And then there's a school of thought that says this is the rally and it's about to end. Which school are you in?
So I'd say I'm in a couple schools. One is that I think we're in a weak dollar environment. So I think the dollar, again, if we go back to when you had me on the show, when I was on the show last in March, the dollar was actually weakening a little bit at the beginning of the year, which was counterintuitive given the tariff noise at that point. And then as the tariffs started to come out in April, the dollar continued to weaken. So I think we will largely be in a weaker dollar environment, which is good for international investments. I also think from an equity market perspective, we've seen really good performance in AI stocks, crypto stocks, things of that nature. International markets of the U.S. is starting to catch up. I think something like small cap stocks, which have been lagging, just given those are some of the smaller companies, more interest rate sensitive. As rates have come down, small cap stocks have started to do better very recently. So I think of a part of the market that's lagged that may catch up is small cap equities. And would also be helped from a deregulation front and whatnot.
So you do believe that whatever kind of rally we see into the end of the year will be broad enough to include small caps?
Assuming we get the interest rates that stay where they are, continue to come down, I think we will get that from a small cap perspective. And they've lagged this year. But if you look at some of the recent moves in small caps relative to interest rates, just starting to come down on these lower inflation prints and expectations that the Fed will be able to ease, small caps have started to pick up. And when you talk about what's been loved or not loved, large cap US stocks, AI stocks, they've been loved. International stocks that had not been loved, they're starting to get a little more attention given their outperformance, here through 7.5 months of 2025. Small cap stocks haven't gotten that. So it's a little bit of a contrarian relative to what's been working. At the same time, you need the economy to do well. If you go into a recession, small cap stocks are not going to do well. Those are some of the more exposed firms, being smaller firms.
In terms of areas of the market, regardless of cap size, I mean, obviously AI has been the big driver, but are you more interested right now in AI or are you more interested in AI adjacent?
So I think AI adjacent. Look, we have a great team at Voya that runs AI strategies for investors globally, and what they really focus on. Obviously, there's direct AI stocks like Nvidia, but there's also AI adjacent, and every company is looking at how to use AI. So I think it's a large theme we see in a lot of companies. We see it in the power sector and the energy sector. How much energy are we going to need to create and produce to power data centers, to power compute, to power manufacturing of chips and things of that nature. So yeah, I think there is a large opportunity. And I am not the expert. Fortunately, we have a lot of experts that work on our investment platform at Voya. The AI theme is with us for a long time, and it's broader than just the most narrow of AI stocks for sure.
We've been in a bull market now for several years. I mean, even if we just coast to the end of the year, we'd be in another double-digit year if things were to end as they are right now. And it doesn't sound like you've got real trouble in your forecast ahead. So how long does this bull market go? And have we had in your mind the corrections or what have you? We've just had them in a rolling basis instead of the classic recessionary kind.
It's a fantastic question. I think it's very tough to predict bear markets or recessions because, as you mentioned earlier, like if everyone's bearish and kind of pricing it in, things typically, at least from a market perspective, maybe more in a macroeconomic perspective, have to get worse than expected for that to happen. So I do think, maybe a more benign, but also I'd say realistic scenario is that we've just front loaded a lot of returns, that it will be tough for the markets to do double digits every year. It's just not, statistically likely for a long, long time. But I would say we've had good economic growth. And, U.S. companies have strong profit margins that are good at making money and good at producing for shareholders. So I think that's been a large reason we've seen that. But yeah, does that mean double digits every year from here ad infinitum? No, that's not likely.
What's your nightmare scenario? What's the thing that you are scared of? And it's probably not something we've discussed because those things are at least priced in.
Yeah, I'd say if inflation risk premia picks back up, whether it's through tariffs, whether it's through political noise around the Fed, whether it's through the amount of debt the U.S. has to issue. Again, if we go back to that week, Monday, April 7th through the 8th and 9th until the pivot on tariffs, you saw illiquidity, some illiquidity, not huge, but some illiquidity in treasury markets. And you saw foreign investors pulling out of treasury markets, causing yields to go up. I think that's what got Bessent to convince Trump to make the turnaround on tariffs. So if you saw yields go up for any of those reasons, pullback of foreigners, higher inflation risk premium, higher debt issuance, that would cause markets to sell off. Markets, the underpinning of pricing assets is versus a risk-free rate. You can pick whatever risk-free rate you like, but the 10-year Treasury, U.S. Treasury is as good a proxy as any. So to me, that's the nightmare scenario, that yields just shoot up and it reprices capital markets broadly.
Last question in limited time. There have been a lot of things discussed on this. And of course, a lot of the stuff you have talked about has been based on numbers. There's a lot of talk about what's happening right now at the BLS with changes at the top, et cetera. How concerned are you about the inputs you're going to be seeing going forward? Like if we see a shift, we intuitively think inflation is going to keep rising because of tariffs. If we suddenly see a shift with a new guy in charge, how much do you start to discount the numbers?
Yeah. So look, I think it's an important topic to focus on. Obviously, having really solid statistical agencies, is a backbone of having a good economy and financial system. I'm one that also looks at markets. And so, yes, you can have a million economists that can run their own numbers against the BLS, and there's the ADP payroll number, but I'm also a believer in kind of the wisdom of financial markets. And so if you saw prints that were, better from the BLS side, either more jobs or lower inflation or whatnot, but wasn't corroborated by financial markets, I'd start to get concerned then. So I think it's an important issue that we're talking about. I want to see how it plays out in the actual prints of the numbers that come out.
Eric, great stuff. I really appreciate the help and the time. We, of course, will be watching it play out. We will talk to you again, which will likely be in 2026. So enjoy the rest of the year, but come back and talk to us as we get in and get your outlook.
I definitely will, and can't wait to join you again in 2026.
That's Eric Stein. He's the Chief Investment Officer at Voya Investment Management. Voya, V-O-Y-A. You spelled it because if you want to learn more, it's voya.com. And we will be back to wrap up not only this show, but to put a bow on this week on Money Life. And we will let you know what's coming for next week. And then we'll finish it up right after this message.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
So it's another week already.
It is hard to believe, made it through another week, made it through a week without, at least to this point, having had the grandchild who was due on August the 14th, so we're already into overtime, if you will. But I'm super excited. Maybe it'll happen this weekend. My daughter is betting that it's happening on her birthday, which is August the 21st. And she's betting that, by the way, because she is 31 years old and she is due on August the 14th. And when she was born, her mother was 31 years old and also due on August the 14th. So she's thinking since she took an extra 7 days, her baby's going to do the same. We'll see. So we don't have crossover in the classic sense of what happens when we have a market call, but there's a bit that happened between Money Life and the headlines. Yesterday on this show, Jeff Mullenkamp put a sell on UNH, United Health Group, right? And on Thursday, well, as you know, long after we had aired the thing with Jeff, there was a new filing that was released by Berkshire Hathaway because hedge funds had to do a filing at the end of last month, and it got published and released yesterday. So Berkshire Hathaway, the company, of course, made famous by Warren Buffett, was taking a big position, a new, never had it before, $1.5 billion position in UNH. And if that wasn't enough, Soros Fund Management and Appaloosa Management also made their filings. They disclosed big purchases in UNH too. Soros, of course, for George Soros. Appaloosa is run by David Tepper, the one who owns the Carolina Panthers, not the president of Tepper Capital Management, who's been a guest on the show in the Navigator segment a few times. And so we're always talking about crossover here on the show, but you should also be paying attention to what others do. Now, on the show, we had very different crossover. We had crossover between Matt Freund and Eric Stein on small caps today. But compare what they said to Amanda Agati from PNC, who started us out on Monday saying she expected the market to broaden out, but only to the S&P 500, not all the way to small caps. And then you had all of our guests today basically agreeing on a downturn and some turbulence in the fall around likely rate cuts before you get a year-end rally to make things a little easier as we roll into 2026. And that has been a very prevalent theme on this show. Great guests is a theme on this show. And next week, we got a bunch of them, including Bill Stone from Glenview Trust, Ryan Dietrich from Carson Group. He'll be here on Monday. Alan Gale from Villanova Investment Management, and more. Dan Skubitz from FM Investments will be here. So it's going to be a great week to be living the money life. Plan to be here with us. If you are looking for something to celebrate, today is National Relaxation Day. So you should relax and you should celebrate with your best friends because it's also Best Friends Day.
Just to be clear, you and I are not friends?
Well, you know, if you're talking about me specifically.
Hi, I'm Chucky, and I'm your friend to the end.
Yeah, I'm not your friend if you're calling me Chucky. Just remember that. It is also National Failures Day.
Failure is not an option.
Apparently it is today. It's National Men's Grooming Day, National Back to School Prep Day, National Leathercraft Day, then importantly, National Kool-Aid Day, and National Lemon Meringue Pie Day.
Wow! A pie!
Meanwhile, my guests were Matt Freund, Co-Chief Investment Officer at Calamos Investments, calamos.com, the website, Jeff Bishop from RagingBull.com, and Eric Stein, Chief Investment Manager at Voya Investment Management, Voya.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Ozzy Osbourne from I Am Ozzy, his book. He said, you got to try and take things to the next level or you'll just get stuck in a rut. Well, that's what we want for your finances. It's what we want for your life. So this weekend, go out and make the most of it. Take things up to the next level. Do all those things you want to do. Trust me, I've got great plans for this weekend. But while you're doing all those things, keep money in perspective. And remember, until we do this again the next time, the best thing you can do for your money is not worry too much about it. Have a great weekend, everybody. Stay safe and calm. We'll see you here on Money Life again on Monday.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
I believe someone has failed to terminate my program.